Greetings, it is time for our monthly monetary creation report. And as always, we go to the Yardeni balance sheets report, where we get monthly updates on the major central banks of the world in terms of how much money they are printing or deprinting. The format of this has changed of late. And the China data is slow to update. That's why this video has been produced later relative to the month being discussed than used to be the case. So we scroll all the way down to figure 15, where we have the four major central banks of the world comprising 85% of all monetary creation in the world. The green is the US Federal Reserve, blue is the European Central Bank, red is the Bank of Japan, and purple is the People's Bank of China. You can see that all four of them did a large amount of money printing in the COVID-19 crisis, and many have been deprinting, most of all the US and Europe. They have been deprinting their total amount. Now, this means that the US is still only about 1/4 of all money printing. That is why you should not pay attention to people who say, the Federal Reserve has printed so much money, that's why gold will rise in price, because they're talking about the central bank of just one country out of these four and attributing the money printing of the US to the rise in price of globally priced commodities for which there's worldwide demand. In this case, gold, but also silver, oil, anything like that. And the US was not even the largest printer. The highest of all was the European Central Bank, where they've also deprinted a lot. Now, since money printing is worldwide and technological deflation that is offset by money printing is worldwide, we have to take the grand total of these four central banks, and for that we go up one chart to this one over here, and we're interested in the blue line. The red line excludes the Chinese central bank. The blue line is the total of all four, but the Chinese central bank, as I mentioned, is slower to update. That's why this line is behind the red line in current data. But nonetheless, the blue line is at $25.4 trillion of money printing, and notice that this vertical axis is logarithmic. At the highest point, it was over 31 trillion, but about 6 trillion has been deprinted. It's still much higher than it was before pre-COVID, but it's still in accordance with this long-term trend line established in 2009 and 10. But the broader trend recently has been deprinting based on these central banks, but then central banks have been doing off-balance sheet printing, as I will talk about in a couple of minutes. So this is the cumulative amount of money printing, which has to offset technological deflation, which is also rising exponentially because technology is becoming a greater and greater share of the world economy due to the accelerating rate of change and exponential technological progress. So what is the annual growth rate of this? I have always said that this has to rise at 16 to 24% a year just to stay current with the rate of technological disruption. So this is the annual growth rate. And over here also we take now this red line. This is a little bit confusing because in the previous chart the blue line is the one that included China, but now the red line is the one that includes China. That's okay, the red line is the annual growth rate of the sum total of cumulative money printing of all four central banks combined. At the highest point it was 45%, and that is why we got a brief blip of inflation for 1 year, as we'll see in part 2 of this video, but that disappeared as quickly as it came. This is a level at which even I say there can be temporary inflation, and that was proven to be correct. But the cruising speed should be 16 to 24% a year. And this has been in a deprinting footing for quite some time. It's at minus 8.8%, and that is a substantial deprinting, partly to undo this, but nonetheless the cruising speed should be over here, and most of the time it is below that. So this is the annual cumulative growth rate of money printing. But if we go back over here, we see this indicates deprinting, but for the first time we are seeing another problem, which is that the stock market is rising even as these balance sheets are falling. As we go to figure 12 over here, this is the sum total of money printing, and for many, many years these two things were very closely tied. When money is being printed, the stock market rises. When there's deprinting, there is a fall. But now amidst this deprinting, the blue line, the S&P 500, is still rising. So either this has to fall over to this level, and that is why I did all those crash watch videos, or there is a second type of money printing that is going on in addition to the first kind, and that is why this has decoupled, these two lines have decoupled. So this does not disprove the third millennium economics thesis, the Atom's thesis. It just reveals that central banks might be printing in a manner that does not appear on balance sheets, so that critics who fixate on the balance sheet to oppose money printing don't know where to look for that. So for that, we go to money supply in the US. This is the Federal Reserve M2 money supply, and this is a US only metric. I wish we had a worldwide measurement for this, because then we would have an apples to apples comparison that corresponds to the sum total of the 4 major central banks. But this is the money supply in the US that is growing. And at the 10-year level, you can see this was rising steadily. The COVID-19 crisis triggered the printing that I mentioned before that made this rise quite a bit. And this was correcting down, as one would expect, from the de-printing. But now this is rising again. We just saw that the sum total of the 4 central banks should lead this to be down here, a couple trillion lower. Yet this is rising again. If I look at a 5-year chart, we can see this same phenomenon here. But again, it's rising. It is not falling at the trajectory that ought to have put it down to about here, at the 19 trillion level or so. So this money supply is a good 10% higher than one would expect it to be based on looking at the balance sheets, which leads me to think that there is additional money printing done by the central banks of the world, not just the US Federal Reserve, but all of them, causing money supply to continue to rise while they create the appearance of de-printing at the central bank level. So they're printing money in a way that very few people can detect, and that is why the stock market keeps rising, despite the headline level narrative that they're doing quantitative tightening and balance sheet reduction and things like that. Clearly, there is money printing going on that is not recorded on the balance sheet. Now, despite this, inflation is not high at all because of technological deflation in between. And longtime viewers know what my Atom thesis was about, now called Third Millennium Economics. So despite the fact that money printing is going on, we now go to part 2 of this video to examine how much inflation there is and whether money printing is finally causing aberrantly high inflation. So we continue to part 2. It is time for my monthly inflation update. And as always, in my monthly inflation update, we go to my familiar 3-parameter matrix. This matrix is going to be retired soon and updated with something more modern because we are close to graduating into a higher phase of third millennium economics, and that is a phase that I discuss in this video in the upper right hand corner over here. But for the moment, July 13th, 2024, we are still going to use my 3-parameter matrix. And for those who don't know, what this is that all 3 of these measurements have to be above 3%, and these are all long-term measurements so as to smooth out noise in inflation measurements, because people get too fixated on noise and then forget when the noise went away. The 10-year compound annual growth rate of the US CPI, Goldman Sachs Commodity Index 10-year compound annual growth rate, and the 10-year US Treasury yield. All 3 of these have to be above 3%. Before I say inflation is structurally high. It's not structurally high when just one of these 3 is above 3%, but the others are well below. And the most important measurement of the 3 is the Goldman Sachs Commodity Index, because commodity prices are the purest form of inflation, where you can simplify it down to what average people think about inflation. It is where a price decline is unambiguously good and price increases are unambiguously bad. That's only true with commodities. That is not quite as true with service prices, because service price inflation is simultaneous with wage increases. The service customer is paying more, but the service provider is also making more. So it's ambiguous in that case about whether that's a bad thing or not. So the Goldman Sachs Commodity Index is the premier measurement. Also, it is worldwide and unriggable. So the entire narrative of how inflation statistics are rigged to understate inflation, that is soundly disproven by the Goldman Sachs Commodity Index, because it comprises of freely traded commodities: oil, natural gas, gold, silver, etc. Now, I normally go through all of these 3 in detail, and I have to have a balance about that because longtime viewers have seen the methodologies many times. First-timers are not familiar with the methodologies, but for that you may wish to go to earlier month videos, because I do this video almost every month. So let's look at the 10-year compound annual growth rate of the US CPI. This is data on the US CPI from the BLS.gov website, the link for which is in the description box below, along with links for the Goldman Sachs Commodity Index and the 10-year US Treasury yield. The recent 1-month reading was minus 0.1, so deflationary, but that's just 1 month. And as you can see, these are the annualized numbers for each of those readings. So if you want to take the 2-month inflation rate and see what that is on an annualized basis, you have to take that to the 6th power. 3 months to the 4th power, 6 months to the square, 1 year is of course straight 1 year. Then for 2 years you take the square root, meaning that if there's 6.1% inflation over 2 years, then that is 3% per year. 3 years you take the cube root, meaning that if there's 15.1% inflation over 3 years, that's 4.8% a year. And the 10-year number, which is the one that fits into my matrix and the one that matters, is 2.8% a year because we have had 32.1% inflation in 10 years, which is 2.8% per year over that period. And just for fun, I calculate the CPI average annual growth rate for the entirety of the 21st century, and it is 2.5%, meaning that from January 1st, 2001, there has been 78.9% inflation. 2.5% per year is what that comes to. So inflation is still trending down, and the 1 year is 3%, which I consider to be optimal, as I have said. But the 10-year is still 2.8%. Yes, this 2.8% reading is more than the 2.5%, which is a superset of it, but the two higher readings are at the 3-year and 5-year mark because we had that brief blip of inflation in late 2021, early 2022, because the COVID-19 money printing was being digested. But now that is more than 2 years in the past, because even the 2-year compound annual growth rate of the US CPI is 3%. And 3% is ideal, remember, for reasons I've explained in many other places on this channel. So how does this fit into the scorecard? For the readings of the Goldman Sachs Commodity Index and the 10-year US Treasury yield, you can check the links below. But on today, January 13th, 2024, we saw that it is 2.8% as a 10-year compound annual growth rate of the US CPI. Goldman Sachs Commodity Index is at minus 0.97%. It is in deflation. It's far, far below this 3% a year compound annual growth rate, which is not even possible anymore, as I will show you when I update this matrix for Third Millennium Economics progressing to another chapter. And only one of these three, the 10-year US Treasury yield, is at 4.189%. Now this is bearish for real estate, and real estate prices have stayed high for unusually long, but this is a negative for real estate. And if real estate prices decline, that would mean more deflation too. So keep that in mind. So I don't care what anyone says. Inflation is not high in the United States. All the data proves that that is the case. People like to whine about inflation because it is a method via which people can see themselves as victims and absolve themselves of any personal responsibility. And inflation is also something that sells. People who are selling gold, etc., like Peter Schiff, who earns management fees off of his gold mutual funds, whether gold rises in price or not, like to sell the inflation narrative because it appeals to less intelligent people. And to study the various psychological vices associated with overstating inflation, see this video in the upper right hand corner, Kartik's Law of Inflation, where I go through all 7 or 8 of the various excuses of how people claim inflation is high and why each of those is not quantitatively sound. And I'll tell you when inflation is high, but in all the years I've been doing this channel, we have never gotten to a point where all 3 of these are above 3%. Now we go to the final section of this video, which is not going to be anything particularly profound data-wise. I usually have a new piece of data that I show. But in this case, let's see some of the commenter reactions. So in last month's monetary creation video, the title of which was $400 billion deprinted, negative printing, in May 2024 alone, I got quite a few comments, and many of the comments are the usual people who are positive, etc. But every now and then you get haters who come on and they either debate via anecdote or they just vent their frustration, but they have no capacity for quantitative assessment. But now it's getting nastier than before, because look at this comment over here. Andrew Jackson 244. You're kind of an evil person, aren't you? Evil for this video. This is a video that presents monetary data, explains why inflation is not high based on a multi-dimensional inflation approach, and based on that, I am evil? No explanation. He couldn't even say why. Right above this is a comment that does not accuse me of being evil, but it's not very intelligent. Just look at the grammar. And on top of the grammar, gold won't go up if everyone prints, okay, bud. Well, gold hasn't gone up. It goes up about 2% a year. It is a very, very underperforming asset. And I give this quantitative assessment, and some people upvote it. But numbers don't sway people at this IQ level. They just don't. Because they think that if gold doubles in 30 years, that is an excellent return, whereas that, of course, is only about 2.4% a year under the rule of 72, which you can study in this clip up here in the upper right-hand corner. It is one of the single most important rules you can learn if you want to be wealthy. But this overlap between being a gold bug and all sorts of other extremely garbage ideologies is interesting, and maybe the explanation is something as simple as garbage attracts garbage. Now, if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.